Picture yourself in Tokyo, this morning of June 17th, 2025, in the heart of a Japan where the economy hums with uncertainty, where every decision made in the hushed boardrooms of the Bank of Japan, the BOJ, could send shockwaves through global markets. Today, a bombshell dropped. The BOJ decided to keep its interest rates steady at 0.5%, but more crucially, it's hitting the brakes on tightening its monetary policy next year. Why? Because the world is spinning into chaos at breakneck speed, with new geopolitical and economic risks threatening to upend everything. This isn't just some technical move for suit-wearing economists. It's a loud wake-up call about the state of Japan, its economy, and the world's and it matters to all of us, even if you're thousands of miles away from Tokyo. So what's going down? The BOJ, the institution steering Japan's economy like a captain in a storm, opted to leave its interest rates untouched at 0.5%, where they've been since January. But the real buzz, the one that's got traders and economists talking, is about its tapering plan, the gradual cutback of its purchases of Japanese government bonds, or JGBs, which are like the fuel for an economy drowning in debt. For the past year, the BOJ has been scaling back these purchases by about 400 billion yen each quarter, aiming to bring its monthly bond buying down to 3 trillion yen by March 2026. But today, it announced that starting in fiscal year 2026, it's slashing that reduction pace in half to 200 billion yen per quarter. It is targeting 2 trillion yen per month by March 2027. Sounds like a small tweak, right? Wrong, it's massive. It's like a driver easing off the gas instead of yanking the wheel, trying to keep the whole car from skidding off the road. Why the shift? The world's getting messier by the minute. On one hand, tensions in the Middle East, with Iran and Israel locked in an escalating conflict, are driving up oil prices. Japan, which imports nearly all its energy, is sweating bullets over the prospect of soaring costs that could derail its economy. On the other hand, there's the United States, where new trade policies, think tariffs slapped on by the Trump administration, are threatening Japan's exports. Japan's an export powerhouse. From Toyota cars to Sony consoles, its economy thrives on open foreign markets. If the US, its biggest trading partner, slams the door shut, the whole economic model wobbles. And then there's China, the other giant next door, whose slowing growth is putting even more strain on global supply chains. But it's not just external chaos. Inside Japan, inflation is running wild. In April, core inflation hit 3.5%, the highest in over 2 years, well above the BOJ's 2% target it's been chasing forever. Why? Food prices, especially rice, a staple of Japanese diets, jumped by 7%. Imagine walking into a grocery store and seeing your bill spike overnight. Companies, hammered by rising costs for raw materials and labor, are passing those hikes on to consumers. And with a worsening labor shortage, wages are creeping up, which could fuel even more inflation. It's a vicious cycle, and the BOJ is walking a tightrope. Tighten policy too fast, and it could choke the economy. Do nothing, and inflation might spiral out of control. What makes this decision even juicier is that it wasn't unanimous. One BOJ board member, Naoki Tamura, voted against slowing the tapering. He wanted to keep cutting bond purchases at the same pace, signaling a no-nonsense stance on tackling inflation. That kind of dissent is rare in an institution known for its unity, and it shows just how high the stakes are. The markets. They didn't waste a second reacting. Right after the announcement, the yield on 10-year Japanese bonds shot up to 1.485%, a peak not seen since early June. Why? Investors are betting the BOJ will offer less support for short-term bonds, pushing yields higher. And when yields rise, borrowing costs climb for the government, businesses, and even regular people trying to buy a home. Let's zoom in. Why are these bonds such a big deal? Because the BOJ owns about half of all Japanese government bonds in circulation, a colossal portfolio roughly the size of the country's economy's 600 trillion yen. For years, it's been snapping up these bonds like crazy to keep interest rates dirt cheap and jolt an economy stuck in deflation. Now it's trying to ease off, to navigate its policy, like a parent slowly letting go of a kid's bike training wheels. But go too fast, and the kid crashes, or in this case, the financial markets tank. Last month, yields on ultra-long-term bonds skyrocketed, a sign investors are nervous about Japan's financial health. With public debt over 250% of GDP, one of the highest in the world, by slowing its tapering, the BOJ is trying to soothe those fears, telling markets, don't worry, we've still got your back. But this isn't just about numbers or market sit. It hits real people hard. With inflation climbing, Japanese households are feeling the pinch. Retirees living off savings see their real income shrinking. Young people, already stuck in a precarious job market, wonder if they'll ever afford an apartment in a city like Tokyo, where real estate prices are through the roof. Small businesses, the backbone of Japan's economy, are struggling to absorb rising costs while competing with global giants. Add a weak yen, which makes imports pricier, and you've got a recipe for widespread economic anxiety. Now, let's go global. What the BOJ doesn't stay in Japan. When the central bank of the world's third largest economy makes a move like this, the ripples spread far. A weak yen, partly due to the BOJ's low rates, gives Japanese exporters a competitive edge. But it's ticking off countries like the US, who want to shield their own industries. Just last week, the US Treasury flat out told the BOJ to tighten its policy to normalize analyze the yen's weakness, rare jab that shows how heated trade tensions are. Other central banks like the US Federal Reserve or the European Central Bank are watching closely. If the BOJ pumps the brakes on tightening, it might signal others to pause their own rate hikes, especially if global risks keep piling up. In the short term, this BOJ move will likely calm Japan's markets, at least for now. Investors, reassured by this cautious approach, might stop panic selling bonds, keeping yields in check. But looking ahead, the challenges are massive. Middle East tensions worsen, or trade talks with the US collapse. The BOJ might have to rethink everything, maybe even ramp up bond purchases to dodge a crisis. And then there's inflation, this beast that won't quit. If it keeps climbing, the pressure to hike interest rates will become unbearable, despite all the external risks. BOJ Governor Kazuo Ueda is walking a tightrope, and the world is watching his every step. So, where does this leave us? This decision is an admission that the world is more uncertain than ever, that old economic playbooks aren't cutting it anymore. It's a lesson in how interconnected our economies are. What happens in Tokyo can mess with prices in Paris, jobs in New York, or growth in Beijing. For Japan, it's a moment of truth, balancing a fragile economy against global pressures. For all of us, it's a reminder that the global economy is a complex puzzle, and every piece matters. What do you think? Is the BOJ making the right call by playing it safe, or is it risking getting steamrolled by inflation and global crises? Drop your thoughts in the comments and share this story if it made you see the world differently. Because at the end of the day, understanding these moves is about understanding the world we're all living in.